Knock, knock, everybody. Derick Van Ness here, investor, wealth strategist, life adventurer, and I got a doozy for you today because everybody's wondering what's going to happen with real estate in 2022. If you look back at my prediction in 2021, everybody was like, oh, it's going to crash. It's, 2007 and 8 all over again. I predicted that it wouldn't, and I explained why. It seems like I was really right on with that one, and I think I'm right on with this one. I don't have a crystal ball, but by the end of this video, you're going to know my thoughts, why I think real estate is going to do what it's going to do, and you might be surprised at what you hear. So definitely check this out, and especially if you're considering investing in real estate, buying a home, or any of that other stuff. There's a lot of stuff swirling around this, and just so you know, I've been in the real estate game since about 2001. I've owned about 170 properties myself over the years, bought, sold, flipped, rentals, Airbnb, short-term rental, all that kind of stuff, lease options, you name it, I've probably done it. Everything except for commercial development, I have not done that. So, good news is I have a little bit of a background. I've been following real estate for probably 15, 20 years now. Pretty in-depth, have a lending background, did that for a couple of years full-time, and a bunch of other things. And now I just help people be smarter with their money. So, let's talk about real estate. And if you like this kind of content, as you're listening and you're like, wow, that really made sense, smash that like button, subscribe to the channel. You can always change your mind later if you don't like it, but I really do try to create real value, try not to be super sensationalized or overhypey about this stuff because I feel like that's all that's on the internet. So if you like good, down the middle, honest opinions, definitely check it out. Subscribe, follow us, and I'll do my best to present good content for you. So let's talk about real estate. Here's the deal with real estate. Real estate provides a real need for real people, and when we stay in that lane, good things happen. So what do I mean? A big part of the crash back in 2007, 8, 9 was people were buying real estate they didn't need just because it was going up. They were speculating, oh, the market's going to continue to go up. I'll buy this house in Las Vegas, even though I live in Los Angeles, and I'll just watch it go up and up and up and up. It'd be cool to have a second house there when I go to Vegas or whatever, but nobody was living in the houses. They weren't renting them out. There was a lot of false demand that really pushed the market, right? And that was really fed by loose lending and requirements that were non-existent. So really anyone could buy any house anytime. That's a recipe for disaster. So fast forward, how does that apply today? What's important about that? What's important is there are real people, real families who want to buy houses right now and can't. Not because they can't afford it, but because there's still a lack of demand. There's still real demand of real people looking for a real place to live, not something speculative, not their second or third home, not a bunch of that. There's a bunch of people living in apartments and condos who want to buy a house, and a bunch of people who already own a house who want to move up to a nicer house, right? The economy's been going up pretty steadily for about the last 13 years, 12, 13 years-ish. So we are really at the top of a great ascension, and a lot of people have seen the stock market go up. They've seen a lot of things go up, and so they have money and they want to move up in the world, and that's awesome. But there's going to be some opposing forces to that and some other things that we want to be aware of. And then as I kind of go through these different forces, I'll give you my summary kind of at the end here. So the other things that are going on is we have inflation. I talked about this about a year ago. I said inflation's coming. We were already in it. I knew it. I tried to let everybody know because it's really, really important that you understand that as inflation goes up, your dollars are worth less. In other words, your dollar buys less stuff because stuff costs more. And let me just tell you, I built a house this year. I've been buying furniture and appliances and all this stuff that's, big expenses. And the reality of it is they are going up at an astronomical rate. I mean, I bought some things in July, and 2 months later, even when they were on sale, 20% off, they were still more than they were the 2 months earlier when I bought it. We went to buy a dining table, and they told us, first off, it's going to take 6 months for it to be here because of supply chain, but second, in about 2 weeks, it's going up 10%. You better buy it or you're going to miss out. Sure enough, it did. Everything else that we've been buying, they're telling us, if you don't buy in the next 2 weeks, it's going to go up in price. So we've seen that. Now, the government right now is telling us that the consumer price index is about, I think it was 7.6, 7.8%. I believe that's a little on the low side. I think we're still seeing more than that. So let's say it's at, let's just say the government's right, it's a 7.8%. That means every dollar you have has gone down in value 7.8% since last year, right? So if you're not earning close to that, you're probably going negative with your money that's just sitting in a savings account or something like that. So that is part of a factor of what's going to happen with real estate, because theoretically the same house should be going up 7.8% just to keep its current value, right, with the dollar. So as people, as things get more expensive, people want to make more, they go to their boss, they get a job. We've been seeing all this job switching this past year, right? Part of that's COVID, but a big part of that is also people are saying, I want to buy a house, I want to buy a car, prices are going up, I need a better job. Employers are saying we need people, so they're willing to pay more for the new person to come in so that person gets a raise and makes more money. It takes a couple of years for that to kind of shake out and really like everybody's moved up, but it's definitely happening in droves right now. So people are making more, stuff's costing more, so your house theoretically needs to go up just to keep up with inflation as long as demand is there. So what's on the other side of that that might pull demand down? Well, the Federal Reserve and the lending rate. Whether you know it or not, houses are purchased based on a monthly payment, not on what they're worth. What they're worth is based on the interest rate. For example, if a $2,000 payment buys you a $400,000 house at a certain interest rate, that's what that house is worth. If interest rates go up, that $2,000 payment might only buy a $350,000 house. Now, people are buying it based on the $200,000 or $2,000 payment, not on the price of the house, right? It's what the payment will buy, and interest rates are your multiplier that determine that. So the higher the interest rates, the more it's going to decrease the amount of house that can be purchased by a particular monthly payment. So we're going to have inflation pushing the price of houses up because people are making more money and the price of everything's going up. And on the other side of that, the government's trying to slow that inflation down by raising interest rates, and the Fed has committed to 3 upticks in the next year. Now, they can change their mind at any point, but as of right now, they've said we're going to go up 1/4 of a point 3 times during 2022. Now, if they do that, that means that the interest rate's going to go up 0.75% this year, and that's going to really slow down some of the buying. Now, if we have enough demand, people won't care. It's just instead of getting the $400,000 house, they'll buy a $350,000 house, and that's fine. And it might even be the same house. It's just people who paid $400,000, their house is going to be worth a little less for a while. At the end of the day, if interest rates tick up enough, it's going to mean people can start to not afford houses. I don't think that's a problem right now. I think there's plenty of buyers who can afford houses and who want houses. But as interest rates tick up, it's going to pull some of those people out of the running, right? They're not going to be able to afford a house. That's going to decrease demand, and it's going to slow down the prices going up because people can't afford them. So we've got inflation pushing it up, we've got people making more money pushing it up, and we've got the Federal Reserve pulling down the value of these large assets by increasing the interest rate. So we've kind of got this tug of war of what's happening. So here's my belief as to where that's going to end up for all of us. We're going to see a slowing as there's the first tick. We might even see a little bit of an acceleration. A lot of people are going to be scared and say, I got to get in while interest rates are cheap, got to do it now. That's probably counter if you're just looking at it from the perspective of an investment, but if you're looking at it as a place to live, you're like, I got to get in while I can afford it. So there might be a real surge that kind of really spikes real estate, but I think by the end of the year, we're going to see a softening in real estate because a lot of those people will have bought houses, and we're going to see demand probably wane a little bit because as interest rates go up, it's going to be harder and harder to qualify for houses. And also, a lot of people who own houses, if you own a house and you paid that $400,000, now it's only worth $350,000, and you get behind, you lose your job, something happens, you've got to sell that house, but you're upside down in it. That may create some situations where we have foreclosures because the person can't just sell their house and get out from under it, or it may mean the bank's going to end up taking those back. And when that starts to happen, when we get distressed real estate, which we haven't had a lot of because people could sell their house so fast, when we have distressed real estate, that starts to pull things down too, because now regular sellers are dealing with a bank selling a property, and the bank is less emotional than the person who's a homeowner. The bank says, hey, we just need to get our money back. We're willing to drop the price. Now you've got to compete with that, bring your price down. So we might see a real softening, and I believe by next year we're going to definitely see that. And it's likely that even after these 3 ticks, the Fed's going to continue to raise interest rates and probably have that impact what's going on with real estate. So it's just going to depend how much demand we have versus those interest rates, but I do think we have pent up real demand for real estate. It has slowed down slightly the second half of the year from what I've seen, but I think we're going to continue to have a strong, probably 6, 7, 8% appreciation still happening, probably keeping up with inflation, but not accelerating like it really has been in certain parts of the country. The other thing to keep in mind is real estate is very, very localized. What's happening across the country may not be what's happening in your world. One of the things that I thought was really interesting is even within Los Angeles, which is where I was flipping houses, when the market was crashing in 2008 and 9, houses in the Hollywood Hills and in West Hollywood like Brentwood, Santa Monica, these kinds of really high-end neighborhoods, real estate was actually still going up at an astronomical rate because the rich were getting richer. They were buying distressed assets. They were cashing out on a lot of their real estate before it crashed, and they had even more money than usual to buy nice houses. So it is very, very localized. So you want to be clear about your specific market, whether you're buying or you're investing. But I do really think across the board, generally speaking, we're going to see a softening in real estate. I don't think we're going to see a crash. I don't see that happening because there's so much money out there and the inflation is happening to offset that. Now we might see a flattening of prices, which would actually be a dip in the sense that the prices look flat, like a $400,000 house stays at $400,000. But if we have that 7 or 8% inflation rate, that means your dollars are worth 7 or 8% less. So your house is actually worth 7 or 8% less because the dollars are worth less that back that, right? So, and I've been calling that the invisible crash. I have an invisible crash video. I'll point to that at the end of this, where we might actually see that happening. You may not realize that we're in a crash, but you'll feel it. It's just the charts won't look like it because inflation will be offsetting that. So I see us going into some inflationary times for the next 1, 2, 3 years at least, probably longer, depending on how quickly the Fed acts. And because of that, we're going to see real estate continue to go up and keep up with that because there is real demand. So all these people who are selling you hoaxes about a crash, and it's going to be 2008 again, just so you know, if you look at the history of real estate, what happened in 2008 has never really happened before except for maybe the Great Depression. It's not a normal part of the cycle. It was an overinflation because banks were making terrible decisions, got super, super greedy, and would give anybody a loan, whether they could afford it or not, and it ended up cooking their bacon, right? That is not happening right now. Banks are still making prudent loans. People are still living in the houses they're buying or renting them out. There's none of that craziness going on. Yes, people are paying more than they should. People are overinflating prices maybe a little bit, but the truth is with inflation, I think that's going to catch up and help make all those people look really, really smart. So I think buying assets right now, borrowing money, because debt's going to get cheaper as dollars are worth less, so it's going to be easier to pay it back, to put it into assets that are going to go up with inflation. Real estate is one of those, but there are plenty of others out there. Is not a terrible way to go right now. It's a way to preserve the value of your dollars because real estate, because there is a real need, adjusts for inflation. So finding those areas and those ways that you want to move your money really, really makes a huge difference. Real estate could be one of them. So just know you're not going to see the astronomical returns this year because of the uptick in the interest rates. You're also probably, in my opinion, not going to see a crash anytime soon. There's too much money out there, too many people who want real houses, and I think that's going to keep us from going into any kind of trough. I think we'll just see a little bit of a slowdown. Anyway, my name's Derick Van Ness. If you want to understand a little bit more about the invisible crash, you can check out this video right here. It's a super cool one. I think you'll love it. Can't wait to see you on the next video. Thanks.